Hello and welcome to this short lecture on accounts receivable as part of our financial accounting series. So let's start by defining accounts receivable. Accounts receivable are often referred to as trade receivables. So, an accounts receivable is the right to receive cash in the future from customers for goods sold or for services performed. Basically, it is when we make a sale to a customer on credit. We sell to them now and they are going to pay us later. This is very, very common in business. We may deliver goods and then send them an invoice and then they'll pay us at a later date. So accounts receivable are sometimes referred to again as trade receivables, and they are almost always treated as current assets because they are usually collected within 30 to 60 days of the billing date. Remember, current assets are those assets that we expect to convert to cash within a 1 year period. So accounts receivable will generally meet that criteria. So here on the screen, you see two entries generally associated with accounts receivable. When the sale is made, this is the first entry. When the sale is made, we are going to debit accounts receivable and credit sales or revenue for the amount of the sale. Okay. When the customer pays us at a later date, we are going to debit cash and credit accounts receivable based on the amount that they pay us. Now, as long as every customer pays their full balance in a timely fashion, the company would just continue indefinitely making these two journal entries all the time. However, it is inevitable that all customers are not going to be able to pay their receivables in full. They may either be unable to pay some of the receivables or they may simply be unwilling to pay, which means that the company is going to face occurrences of bad debt losses from time to time, and that is going to be our focus in this lecture, is accounting for those bad debts. Okay. So, uncollectible accounts, often called bad debts. Now, we have two basic systems for accounting for our bad debts. We have the direct write-off method, we have the allowance method, okay? Now, let's start with the direct write-off method. What is that? So, excuse me, the direct write-off method says that we basically wait until we know for certain that an account cannot be collected. For example, maybe the customer files bankruptcy, or maybe the customer sends a letter saying, hey, we aren't paying this invoice, something along those lines. The company waits for that to happen, and when it does happen, they remove the receivable from the books and record the bad debt at that time. This is the direct write-off method. However, publicly traded companies are not permitted to use the direct write-off method because it does not adhere to GAAP, because it does not follow the matching principle. Remember, the matching principle requires that we match our expenses against the revenues they help to generate. The direct write-off method violates that, which is why it is not allowed for public companies. Now, for very small businesses, they would probably use the direct write-off method. But for our purposes, we assume that we are required to adhere to U.S. GAAP, that's generally accepted accounting principles, and U.S. GAAP requires the use of the allowance method because it allows companies to match the estimated bad debt cost against the revenues generated by those receivables. So now we're going to have to look at how to estimate that bad debt. So we know that we're going to create an allowance for it, but how do we estimate that allowance? Well, we have two basic methods. All right, so let's start with the percent of sales method. Okay, under the percent of sales method, we are going to assume that a certain percent of the credit sales for the period is uncollectible. And this is something that management's going to have to estimate. It's probably going to be based on prior experience. For example, if they say, well, if we look at the last 5 years, normally about 2% of our customers don't pay their invoices. So they might say, okay, 2%, that's our percentage. All right. So when they compute bad debt expense, they would just say, 2% if that's what they came up with, times the amount of credit sales, and there's our bad debt expense. And that's the amount that we're going to record in the adjusting entry. And the adjusting entry is going to be a debit to, our bad debt expense account and a credit to our allowance account, which is a contra account, similar to what we see with accumulated depreciation for fixed assets. The allowance account is a contra account to our accounts receivable account. Okay, so percentage of sales focuses on sales. It's often called the income statement method. We just come up with some percentage that we're going to estimate of sales. That's our bad debt amount. That's the amount that we record for the journal entry. Now, the more common method is the percentage of receivables method. This assumes that a certain percentage of a company's receivables are not collectible. And the most commonly used technique here is the aging method. We're going to look at an example of that on the next slide. But what the aging method does, instead of just saying, well, let's say 4% of our receivables are not collectible, what the aging method does is it says, well, let's not apply a single percentage to all of our receivables. Let's look at the age of our receivables, and based on their age, we're going to come up with a different percentage for each little age bracket that we think is uncollectible. Now, the interesting thing about the percentage of receivables approach is our adjusting entry is not going to be the amount that we compute, because the amount that we compute is the amount that we want to have in our allowance account. Okay? So our adjusting entry is going to be whatever entry is necessary to bring that allowance account to the desired balance, okay? And we'll talk about an example of that in just a moment. Okay, so here we are going to look at the aging method. Okay, what you see here is an example of an aging schedule. And again, this is a form of the percentage of receivables method, but rather than applying a single percentage to the total accounts receivable, we're going to evaluate the likelihood of collectability based on the age of the receivable. So the first thing that we have to do is group our receivables into buckets based on their age. The first bucket for the receivables are going to be those that aren't yet due. Maybe we just sent those invoices out. Next, we're going to look at receivables that are due basically within 30-day increments. Okay, so we've got some that aren't due at all yet. Okay, so these customers aren't even past due. Then we take our customers who are past due and we group them into little 30-day groups. So 1 to 30 days past due, 31 to 60, 61 to 90, over 90. And different companies may have different buckets, but this is a pretty common approach, okay? Going in 30-day increments is a pretty common approach for the aging method. Okay, and what you'll see down here is the percentage estimated as uncollectible. The older the receivable gets, the bigger that percentage gets, okay? And really, if you just kind of think about it, it makes sense, okay? The older a receivable gets, the less likely we are to collect it, okay? If something's over 90 days past due, most likely if the customer had the money and was willing to pay us, they would probably have already paid us, okay? So that's why you see these percentages getting much, much higher the older the receivable gets. Because remember, this is basically the likelihood that we are not going to collect it, okay? So the older it is, the higher it is. But with the aging method, we compute our total receivables in each of these buckets, and then we apply that percentage to this bucket. Okay, so for not yet due, we've got a total $740 is what we're estimating as uncollectible based on a balance of $37,000. Here we've got receivables of $6,500. We think 5% is not collectible, so we've got another $325 there. 31 to 60 days, $3,700 is what's in receivables. We think 10% of that's not collectible, and so on and so forth. And then, so when we come up with our estimated uncollectible amount, we just add all of these buckets together. So 360 plus 475 plus 370 plus 325 plus 740 gives us a total estimated uncollectible amount of $2,270. Okay, so this is the balance that we want in the allowance account. This 50,000, that is what we have in our accounts receivable account. This 2270 is what we estimate should be the balance in the allowance account. Now, our adjusting entry will simply be whatever it takes to get the allowance account to a credit balance of $2,270. Okay, so here's a quick summary here. In terms of journal entries, the process is a bit easier under the percentage of sales method, in that our journal entry is simply whatever we compute. Okay, it is just slightly more complex under the balance sheet focus, where we compute what the balance should be in the allowance for doubtful accounts. And then our adjusting entry is simply whatever it takes to get to that balance. Okay, so just as an easy example, let's say that we compute that our allowance for doubtful accounts should be $800. And let's say that we look in our general ledger and we see that the account currently has a balance of $500. Okay, then our journal entry would be for $300, because if we are sitting at 500 and we need to get to 800, 300 is what it takes to get there. So you can kind of think of the journal entry that we use under the balance sheet focus. You can think of it as a plug entry, or sometimes in accounting you'll hear it called a true up entry. A true up just means we are going to record whatever we need to record to get a certain account to the desired balance. So this is just kind of a quick summary and highlights of what you're learning this week about accounts receivable. So thanks so much for watching.